See, silver and gold take a different view globally as something that is probably worth more than the dollars and the currencies that are used to purchase them. It is a race. This isn't about 2 or 3 brothers trying to corner the market in 1980. This is the realization by sovereign nations that gold and silver are vital in every way to a thriving economy. Gold will be tied to the monetary system. The system has lost all trust. It will marry, I believe, to blockchain technology. And silver, the reason I think when you think about silver, think of it this way. People never really understand what that means. It just means 90% of its weight. In $1,000 face value, if it were uncirculated, there would be 723 ounces of pure silver. But the industry will guarantee 715 ounces. In other words, they say up to 8 ounces could be worn off of 1,000 face through being running through coin counters for 50, 60 years. It's actually probably almost exactly 720 ounces. But in other words, you take that and divide it out, a dollar's face is 0.715 guaranteed of pure silver.
Andy Schectman, CEO of Miles Franklin, explains that gold and silver are increasingly viewed worldwide as more valuable than fiat currencies themselves. According to Schectman, this is not a speculative race like past market squeezes, but a strategic shift by sovereign nations recognizing precious metals as essential to economic stability. Gold, he argues, will eventually reconnect to the monetary system, potentially alongside blockchain technology, as trust in currencies erodes. Silver's importance lies in its tangible value and industrial utility, illustrated by historic U.S. coinage standards guaranteeing roughly 715 ounces of pure silver per 1,000 face value. Together, gold and silver are reclaiming their foundational role in global finance. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Deutsche Bank on January 5th issued, in other words, they delivered 3.27 million ounces. And who are the buyers? JP Morgan and Citigroup. They are the largest derivatives holders on the market. Now, when I say JP Morgan has flipped, according to the Economic Times, that doesn't mean that they don't have short contracts. They do. It just means that they're net long and exposure to more long than short, which is a big rarity. But the bottom line with all of this is that the deliveries coming by the most sophisticated, well-funded traders in the world who are not using leverage, that is more important than anything. Yes, you can talk about the fact that it has been classified a critical mineral. Huge. You can talk about the fact that the European Union did it at the end of 23. Huge. You can talk about the Chinese export restrictions. Huge. But when the most well-informed traders in the United States are standing for millions and millions and millions and millions and millions of ounces of silver every single month for going on 15 months now, that tells me that we are nowhere near the top. But you have end of quarter, end of month, end of year, selling, balancing books, taking profits. There's something on COMEX that is called Section 1256. Most people haven't heard of it. It basically says if you trade gold or silver futures on a registered exchange like COMEX, that you, no matter how long you hold the trade, it could be a day, it could be a week, it could be minutes or hours. When you sell it, the IRS automatically treats 60% of the gain as long-term, 40% as short-term. And that's a very big deal for active traders, of course. And of course, at the end of the year, the IRS also assumes that all open futures positions are marked to market. So there's a lot of, they can sell it, book it, buy it right back, and it doesn't trigger the wash rule. 30-day wash rule is something in securities that says if you sell a security for a gain, you can't buy it or anything else like it, or a loss, excuse me, more appropriately a loss. A very wealthy person sells a rental property for a big loss to offset a gain on Apple stock or something. You can't buy that or something similar back to it for 31 days. So in any case, all I'm simply saying is that there are a lot of things happening at the end of the year, whether it be shaking the bushes, huge deliveries, rules on COMEX that kind of make traders clean the books and then come back in. And then, of course, we have some other things that we'll get into about silver that I think are going to make this month incredibly volatile, incredibly volatile. the rebalancing of portfolios where silver has gone up so high, it's now a disproportionate share of portfolios has to be rebalanced. Same time, you got hedge funds, the January effect they call it, coming in with all this cash. What are we going to buy? How about the best performing asset of 2025? Now that just got hammered down because of rebalancing, because of all of these things. No, the deliveries expose the rhetoric that these players who are standing for possession of billions every month are not doing this for the hell of it, Adam. It's just beginning. But to think it will be easy is fooling yourself. It will not be easy. Right. The physical holding means nothing. I mean, there's no reason to sell your physical, not even close. But the paper price, which has a lot of speculators involved playing against some of the biggest institutions in the world with unlimited checkbooks, they won't make it easy for those guys and gals to hang on. They're going to get shook, I think, extremely hard over the next couple of weeks into the end of January.
Silver markets are entering a peso, highly volatile phase as major institutions continue taking physical delivery on COMEX. In early January, Deutsche Bank delivered over 3.2 million ounces, with JP Morgan and Citigroup now among the largest derivatives holders, standing for the metal. According to Andy Schectman, this sustained physical demand from the most sophisticated traders signals that silver is far from a market top. While year-end rebalancing, tax rules like Section 1256, and profit-taking pressure paper prices, underlying fundamentals remain strong. With silver classified as a critical mineral, export restrictions tightening, and hedge funds re-entering, January volatility may set the stage for the next major silver move. Let's get back to the interview.
Physical holding means nothing. I mean, there's no reason to sell your physical, not even close. But the paper price, which has a lot of speculators involved playing against some of the biggest institutions in the world with unlimited checkbooks, they won't make it easy for those guys and gals to hang on. They're going to get shook, I think, extremely hard over the next couple of weeks into the end of January. Turn it into what's called shot, little BBs, ball bearing size things that they can then melt down and turn into bars and rounds. Now, this whole process, especially when they're continually getting stuff in, could take weeks, 4, 5, 6 weeks of various stages of production. And they're hedged. They have to hedge that silver that they took in, they paid for from the public. So they got millions and millions and millions of silver inside the various stages of production that they hedged. But what's happening? Silver has been moving up so fast, and they're not pulling this stuff out or making the refined product fast enough. They're getting margin called. And they're like, oh my gosh, silver's going up. Our short position's getting margin called just like these traders are. Pony up the money or your position gets liquidated. So they stopped taking new silver orders or refining orders weeks ago. And so this silver months ago, this silver just sat there where now the big houses are saying, fine, I'll pay you. Go to all the big houses, all the big primary distributors, buy everything, buy it all. There's no downside. You know, we can melt it down if we have to. We have that capability in our warehouse. We have a smelter. We can melt it down and
that's cool.
Send it to the Royal Canadian Mint for pool credit. Whatever we want to do, we can do with that, but there's no downside. And I think that's what you're seeing right now as the reason the premiums rise. It's what it costs to get it after you sell it. So if we sell out of this, how much does it cost me to find it and get it now? It cost me over $1 plus more than it did for the last 3 months on premium. And I think that will continue to move forward as these kind of values don't come by, but once every so very, very frequently.
Okay. Well, kudos for having the foresight to do that. Again, thank you for making the great deal you were getting available to this audience with letting them buy it for $1.
They'll say $1.35 over for now until that changes.
Physical silver markets are tightening as paper price volatility shakes out speculators, according to Andy Schectman. While long-term holders have little reason to sell physical silver, rapid price moves are creating stress for refiners and dealers. Hedging large inventories. As silver rallies faster than refining and production cycles can keep up, margin calls are forcing delays, halted orders, and rising premiums. Major buyers are stepping in, purchasing all available silver with confidence they can remelt or redeploy it later. This supply squeeze explains higher premiums, not speculation. Schectman notes such conditions are rare and often precede major structural shifts in the silver market. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.